Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello students, welcome to second PUC Business Studies online classes. In the previous class, friends, we have covered functions of financial market, isn't it? Now let us move on to the next part, that is money market. See, financial market can be divided into two categories. First one is money market, the other one is capital market or financial market. So, money market and financial market, the basic difference is that money market is short term and financial market is long term. That is the only basic difference. Now let us study about the money market. Before that, I told you, in case of that is a financial market, we deal with different instruments, securities like debentures, shares, we invest, and because of the computerized system, online trading system, the transaction cost have been drastically reduced nowadays. So now financial markets, they perform these functions like reducing the transportation cost, reducing the transaction cost, then even mobilization of savings and channelizing them into productive areas, isn't it? Now, what is money market? The major part, that is first part is money market, the other one is capital market. So, if we prepare a diagram, that is financial markets, two categories, one is money market, the other one is capital market. This is short term and this is long term. That is the basic difference between the money market and the capital market. Now let us know what is money market. Money market is a market for dealing in short term securities, that is buying and selling of short term securities or some instruments of short term period and are highly liquid. You know what is liquid? Highly liquid means which can be converted easily into cash, that is highly liquid, and the securities bearing a maturity term of less than 1 year. So first one is less than 1 year. Then they are highly liquid and what else? Unsecured. They are not secured because no charge will be created on any assets while issuing those securities. Suppose if I want to borrow a loan, I have to pledge my property or maybe some that is gold or something like that, isn't it? So we have to give some security. If you go to bank and if you ask for gold loan, they will ask us to give the gold, and on the basis of the value of the gold, they will provide maybe 75%, 80%, 85% of the gold value will be given in the form of loan. If the loan is not repaid, then the gold will be auctioned by the bank and they will recover the amount. In the same way here it is unsecured, means there is no guarantee of return. 100% cannot be guaranteed. Though it is short term one, we cannot say, isn't it? Because when we deal in when we invest in short term securities like banks, maybe cooperative societies, is there any guarantee that we will get our funds back? No, there is no guarantee. So it is totally unsecured one, but the liquidity position is very high, liquidity will be more for those instruments, and it is a short term duration security. Those are short term duration securities. Then, who are the major players in money market? Who deal or who do the transactions in the money market? Mainly Reserve Bank of India, then commercial banks, then what? Commercial banks and non-banking financial institutions or non-banking financing companies, non-banking finance companies. Who are the non-banking finance companies? Those who are not doing the banking transactions, isn't it? Those who are not in the banking line but they provide finance, they are called non-banking finance companies. They provide finance, they give loan, but their regular business is not banking business. There is accepting deposits, lending of funds, all these are not their activities. So, Reserve Bank of India, commercial banks and non-banking financial companies, they are the major players in the money market. So, money market is a market for short-term securities, or where short-term securities are bought and sold is called money market in simple terms. Clear? Yes. Now, let us move on. What are the instruments that are dealt in the money market? There are many instruments that are dealt in the money market. Let us know one by one. Let us study one by one. What are those? So, instruments of money market. Instruments of money market. Money market. Yes. Right, one by one. First one is Treasury Bills. Treasury Bills. Treasury Bills. What are Treasury Bills? They are the instruments, they are financial instruments of short term duration. It is a less than 1 year. Less than 1 year. These are the instruments of less than 1 year which are issued by the Reserve Bank of India, RBI. Why the bank issues these treasury bills? Because bank wants to collect money, isn't it? That is like during there's a COVID, isn't it? From where the fund comes, all the commercial activities comes to maybe zero. Then where the government will get revenue? Whether the government will get revenue? No. So what the government will do? Through the central government will instruct the Reserve Bank of India to collect funds. So during that time, the Reserve Bank of India will issue treasury bills to the public. And public will purchase those treasury bills, isn't it? And banks also may purchase the treasury bills, and the money flows into RBI's treasury, so that there will be fund. So this is called treasury bills. They are the instruments of there is a lower period, lower term, and they are unsecured one, but the return is almost guaranteed, and they are issued at a discount. We call it as coupon rate, and they are redeemed at par. Meaning is, suppose the RBI is issuing, that is treasury bill of rupees 10,000, it will be issued at a price lower than its face value. Suppose the face value is 10,000, it will be sold, it will be issued at rupees maybe 9,500. And while returning or redeeming after 1 year or after that term, the RBI will pay rupees 10,000 to the holder. Don't you think there is a profit to the holder? There is a return to the investor? Yes, it is. Because investment is 9,500 and while redeeming, while encashing, the person, the investor will get 10,000. So there is a difference of rupees 500. That is the profit for the investor. So this is called treasury bill. And treasury bills are like a zero coupon. We call it as zero coupon bonds, isn't it? And the people who purchase will not be at high risk. So risk is less, low risk, because term is shorter, right? Longer the term, higher will be the risk. After 20 years, we cannot say what will happen. After 10 years, better than 20 years, we can predict to some extent. But if it is for 1 year or 6 months or 3 months, no risk at all. Risk is very less, because why it is? There will not be much changes within 1 year. But after 20 years, then definitely there will be a lot of changes, isn't it? We cannot say what will happen. So here the risk is less. So this is called treasury bill, a bill which is issued by the central government through the Reserve Bank of India, and they are issued at a discount or the coupon rate, and they will be redeemed at par. And the term of the treasury bills will be less than 1 year, and risk is less, they are unsecured. So these are the points you have to quote while explaining the treasury bill. They may ask you for maybe 4 marks or maybe 2 marks, isn't it? Second one is commercial paper. Commercial paper. Commercial paper. Yes, commercial papers, they are issued for a term from 15 days to 1 year, not more than 1 year. The instrument having a maturity term of less than 1 year but more than 15 days. And they are issued by large and credit-worthy companies. What do you mean by credit-worthy companies? Having more reputation in the market, like your maybe Tata or Birla or Reliance, isn't it? They are having more reputation in the market. If they issue any bonds or anything, then public will not hesitate to invest, because they know the groups are very strong enough, having strong financial base, isn't it? So chances are there it will be subscribed by the public. Public will be interested to invest in such companies. So strong and that is a huge financial companies or credit-worthy companies, they will issue these papers, commercial papers. Again, that is to meet temporary problems. Like, let me give you best example. Company is going to raise money from the market by issuing equity shares or debentures. Crores of rupees, maybe 100 crores the company is going to raise. But to raise 100 crores money from the market, the company has to do some groundwork, like printing the applications, isn't it? Then that is giving the advertisement for that. We call it as prospectus in, that is corporate terms, isn't it? That should be issued to the public. Underwriter's commission should be given, brokerage, everything should be paid. For those things, and approval is required for raising the money from the market. So for doing all these things, some amount is required, maybe 1 crore, 2 crore or 5 crore is required. To raise 100 crores, the company may have to invest, maybe spend rupees 1 crore as expenses. So for meeting these expenses of 1 crore, the company may go for issuing commercial papers. While they issue commercial papers, it will be subscribed and money will flow into the company's treasury, and company can very well raise money from the, issue the shares and raise money from the, that is a market, isn't it? So that is called commercial paper. Commercial paper. These are issued by the strong and creditworthy companies, and they are of highly liquid, having low term, and they are unsecured. And they are issued for a term of less than 1 year but more than 15 days, right? Yes, that is what you have to write. What is flotation cost? Flotation cost. I told you the company may raise money by issuing commercial papers to meet the expenses related to issue of shares, isn't it? Company wants to raise 100 crore. For that, company may have to incur 1 crore as expenses for paying brokerage or any other, that is expenses like printing of prospectus, isn't it? For all these things, expenses are required. So to raise money, any expenses incurred is called flotation cost. So to raise huge money from the market, if the company incurs any expenses in relation to raising funds from the market, those expenses are called flotation costs. That is flotation cost. Remember, they may ask you for 1 mark or 2 mark, what is flotation cost? That is the cost incurred to raise funds from the market is called flotation cost, like brokerage, commission, printing of prospectus, etc. Clear? Yes. Then third one is call money. Call money. This is related to banks. What is call money? Call money means, see, you might have heard about CRR in economics while dealing with the functions of Reserve Bank of India, or maybe in 10th standard you might have studied in social science. What is CRR? Cash reserve ratio. Cash reserve ratio. There is a rule that every bank, all the banks which are doing banking business, they must keep a certain percentage of money as deposit with the Reserve Bank of India. So when the CRR is raised by RBI, if it is increased by RBI, that is cash reserve ratio, if it is increased by Reserve Bank of India, then what happens is that the money flow in the bank's treasury will be less. Because suppose 100 crore is there with the bank, earlier we used to pay 10 crore as 10% was the CRR, we used to pay 10 crore to the Reserve Bank of India as a deposit, isn't it? Now the CRR is raised to 20%, suppose 20%, earlier 10 crore, now we have to pay how much? 20 crore. Don't you think 10 crore extra money is flowing into the RBI's treasury? Yes. So that this much of amount, 10 crore amount is reduced with the bank. Banker may not be in a position to lend it to the public because it is already deposited into RBI's treasury. So what happens ultimately? The cash flow with the banker will decreases. So banker may not be in a position to meet the obligations of the customers. Like they want loan, there is no cash, how to provide loan then? So to meet this problem of temporary shortage of funds, the banks may purchase or banks may borrow money from other banks. Suppose Canara Bank is there, Canara Bank may borrow from other, maybe Union Bank, isn't it? May borrow from Union Bank. So this is interbank transaction. Interbank transaction. One bank borrows money from the other bank to meet temporary that is a problem, shortage of funds. This is called call money. When one bank borrows money from the other bank to meet shortage of funds, temporary shortage of funds, that is called call money. And on this, the borrowing bank has to pay certain amount as interest to the lending bank, and it varies from day to day and even from hour to hour. If it is borrowed for 1 hour, the banker has to pay some amount to that. It is a borrowing bank has to pay some amount to the lending bank. Suppose Union Bank and Canara Bank, isn't it? Canara Bank is borrowing from Union Bank, suppose. Then Canara Bank has to pay some amount to Union Bank as interest, and this amount which is given by the borrowing bank to the lending bank is called call rate. They may ask you what is call rate. It is the interest given by the borrowing bank to the lending bank when they borrow in the form of call money. When one bank borrows from the other bank to meet temporary shortage of funds, the borrowing bank has to pay some amount to the lending bank in the form of interest. That is called call rate. Clear? It will not be called interest, it is called call rate. And this call rate changes from day to day and even from hour to hour. And mostly it will be raised for a period of 15 days. Not more than 15 days. They will within 15 days they will set right the problem, and this amount will be returned to the lending bank. So that is called call money. Moving on to the fourth one, certificate of deposit. Fourth one, certificate of deposit. Certificate of deposit. Certificate of deposit, these are unsecured negotiable instruments issued by commercial banks. And they can be issued to individuals, corporations in the sense the companies or firms that can be issued to those people, isn't it? And they are bearer and negotiable instruments. They are short-term instruments. And they are issued for the growth and mobilize a large amount of money for short periods. To mobilize huge amount of money for short periods, these are issued, and the problem will be set right. When there is companies, they are issued to individuals, corporations and companies during periods of tight liquidity. That is, there is no flow of cash, working capital requirement is there. That is, to run the company, expenses are there, day-to-day expenses are there, which is called working capital, isn't it? So for that purpose, these instruments are issued. And they are issued by commercial banks. Remember, commercial banks and development financial institutions. Development financial institutions and commercial banks, these instruments are issued, so that temporary problem of the companies can be met. Let me give best example. We have purchased one elephant, and daily we have to feed that elephant, isn't it? So we might have paid maybe 10 lakh or something like that, whatever it is. Now every day we have to feed the elephant. For feeding the elephant, if money is not there, then elephant will die. Isn't it? In the same way, when we start corporate entities, when we set up corporate entities, we must make sure that to run those corporate entities, some sort of money is required to meet the day-to-day expenses like salaries, wages, and all these things, telephone bills, electricity charges, or whatever the name you call, which are called routine expenses. To pay for the raw materials, we need some sort of amount, money, and that is called working capital requirement of the corporate entities. So to meet such tight liquidity of the corporations, business organizations, the banks will issue, commercial banks will issue these type of instruments which are called certificate of deposit. Okay. Then last one is commercial bills. What do you mean by commercial bills? These are the bills which are drawn and accepted in normal business transactions. Whenever there is a credit sale, the seller will draw a bill on the buyer. If the buyer is an individual or corporate entity, isn't it? Doesn't matter. But bill will be drawn and it will be accepted by the buyer, and it will be shown as debtor, an asset in the balance sheet. When money is recovered from the debtors, debtor gets vanished from the balance sheet and cash balance will increase. There will be change in the form of asset from debtors to cash. Don't you think so? Yes. So in normal business transactions, whenever there is a credit purchase or credit sale, we used to draw bill and we used to accept the bill so that the credit, that is transaction, gets effected without any interruption. Even if there is no money, we can do the transactions, we can earn profit, isn't it, by using these, that is instruments which are short term in nature and they are negotiable and can be transferred by endorsement and delivery, isn't it, from one person to another person. Those are called commercial bills, and they are short term in nature, maybe 3 months, 1 month, 2 months, like that, maybe 6 months, not more than 1 year. Their term of maturity will be maximum 6 months and it's less than 1 year, always remember. So these are called commercial bills. And different types of bills, like accommodation bill is there, where no transaction takes place. To meet temporary problem of cash, isn't it, we may draw and accept the bill mutually. Mr. A and B, they may come to an agreement that they will draw a bill and accept without doing any transaction. No transaction will take place here. Mr. A drew a bill on Mr. B for rupees maybe 1 lakh, and both of them are in need of cash. Mr. A and B are in need of cash. So what they will do is, they will come to an agreement that Mr. A will draw a bill on B, and after acceptance by B, the bill will be discounted with the banker. Mr. A approaches banker and will discount the bill. When he discounts the bill, Mr. A will get instant cash after deducting the discounting charges. Maybe A may get 99,000, 1,000 is discounting charges. Fine. Then that 99,000 will be shared by A and B mutually. Suppose Mr. B is in need of 40,000 and Mr. A is in need of 60,000. So 59,000 Mr. A will take, 40,000 Mr. B will take. And after the term of the bill, after 3 months or 6 months or whatever the term is, the bill will be bill will be accepted, and it will be the B will pay the amount to Mr. A. 40,000 will be paid by B to A, and A will contribute 59,000, and the total amount will be paid to the banker. Bill will be met on the date of maturity. Mr. A will pay how much? 59,000. Mr. B will pay 40,000, and on the date of maturity, what happens? Mr. B will accept the bill by giving 99,000 to the banker. So this is what, or 1 lakh rupees to the banker, because 1,000 is the discount given. That will be shared. Discount also will be shared, and amount will be paid to the banker, so that the temporary problem of cash will be set right, isn't it? So that is called accommodation bill. There is financial accommodation, temporary financial accommodation is sought, and both of them got temporary financial accommodation. Their problem gets solved, and the bill will be met. So this is a type of transaction where the bills of exchange or commercial bills are drawn and accepted. So this is about the different types of instruments that are dealt in the money market. So money market is very clear to you now. And what are the instruments dealt in money market? Maybe a question for 4 marks, can't say. Let us move on to the next part, that is capital market. I told you at the beginning, financial markets, there are 2 types. One is money market and another one is capital market. This is short term, and capital market is of long term duration. So what is capital market? Capital market. Capital market is a place where long term securities are bought and sold. Long term securities, that is the securities which are having a maturity period of more than 1 year. More than 1 year, maybe up to 20 years, can't say. Those are dealt with in the that is a capital market or long term market. Remember, in case of money market, only short term securities of highly liquid, isn't it? Short term securities of more liquid and lower term, lesser term of maturity are dealt with. But here long term securities are dealt with. That is buying and selling of long term securities. And again, in case of long term market or capital market, there will be institutional setup. Institutional setup. But in case of money market, there is no institutional setup. Like, you cannot buy from a particular area. Any instrument cannot be bought in a particular area or in a particular building or in a particular place, isn't it? So there is no particular place for, that is short term instruments or money market. It is done over phone or any other means of communication, fax, email, or whatever the name you call. All these communications are used to do the transactions in money market, because there is no particular institutional setup for money market. But for capital market, there will be institutional setup, there will be a particular building, there will be a particular place of trading, all this will be there. It's like an institution. Clear? So that is capital market, where long term securities like debentures, bonds, shares, all these are dealt with. The period, that is a term of expiry of the instruments will be more than 1 year. So that is what the capital market is. I will take up the other part in the next class. That is a distinction between capital market and money market will be taken up in the next class. Now write assignment. Mention the instruments, mention the instruments that are dealt in money market. Mention the instruments that are dealt in money market. Yes, submit the assignment on time. Thank you for watching this video. Thank you.
Don't forget to like our video and subscribe our YouTube channel for all the updates.